Most investors enter 2026 completely unprepared for what's coming. I'm sharing my complete personal investing plan right now. The S&P 500 just returned 27% in 2025. That number matters, but not for the reason most people think. Stay with me. The Nasdaq climbed 30% in 2025. Completely wild numbers. Average annual market return over 100 years. 9 to 11%. Getting 27% 2 years in a row is extremely rare. Be careful. S&P 500 P/E ratio is near 25 right now. Average is 15 to 20. That gap between 20 and 25 is a signal. Not a guarantee, but a signal. Warren Buffett holds 28% cash at Berkshire, highest since 1990. Is he wrong? Or is he seeing something the market isn't pricing in? Nobody knows. But I have a framework for navigating exactly this. My 2026 plan covers stocks, ETFs, crypto, cash and policy risk. Let me start where 2025 left off. What actually worked? My 2025 plan. Consistent contributions, conviction stocks, stay invested. I was right about the election year tailwind. Trump won, market followed. I was wrong about tech stocks getting hurt by high rates. They soared. Admitting that mistake made me a better investor for 2026. Here's why. I moved from 20% cash to fully invested when rate cuts signaled in 2025. Robinhood stock was one of my best 2025 picks. Researched it all summer. Conviction beats trends. I will never apologize for that approach. Now entering 2026, my portfolio is 90% equities, 5 to 7% crypto, rest cash. Critics say I'm too aggressive. I'm 40. I can afford the risk timeline. But 2026 demands one specific adjustment I haven't made before. More cash, more dry powder. That's the shift for 2026. 3 forces shape every investment decision in 2026. All 3 are active. Force 1, tariffs. Massive, misunderstood, directly affects your stocks. Force 2, interest rates. Still high, still dictating capital flows. Force 3, Trump's tax and deregulation agenda. Real opportunity. These 3 forces interact. Getting one wrong costs you money. Let's go through each one. Starting with the one most people get wrong. Tariffs. Trump thinks China pays. They don't. Americans pay. Walmart pays the tariff. Then raises your price. That's inflation. Canada, after 25% tariff. China, after 10% on entry. Mexico, after 25% too. Tax Foundation says tariffs contract the economy long term. Real data. Apple sources most parts from China. High tariffs mean lower Apple profits. Ford and domestic manufacturers? Tariffs could actually help their stocks. You think the president controls the market. He doesn't. Not really. Fidelity data. Sector performance during presidential terms is chaotic. No pattern holds. Democrat versus Republican in power. S&P CAGR difference is under 1%. Political investing is emotional investing. Emotion always loses. Stay calm, invest consistently. Long-term beats short-term noise. Always. But there's one policy move in 2026 that actually benefits your Roth IRA directly. Most people don't know about this. I'm about to show you exactly what it is. Let's go. Starting with the tax policy that changes the conversion math. The Tax Cuts and Jobs Act of 2017 is being extended. That's a major win for Roth IRA conversions. Lower income tax rates mean converting your traditional IRA to Roth costs you less in taxes right now. When you convert a traditional IRA to Roth, you pay income tax on the conversion amount in that year. Lower rates now means cheaper conversion today, and tax-free compounding for the rest of your life. Capital gains tax rates are also linked to income brackets under the extension, not separate brackets anymore. This gives you more flexibility to realize gains in lower income years without a massive tax hit. Not using this window costs you thousands, possibly tens of thousands over a decade. Now let's talk about inflation. Trump wants to fight it, but also lower rates. These two goals conflict. Raising oil production to lower energy prices is one lever. But oil markets don't respond to political will. If the Fed does cut rates in 2026, that becomes a green light to increase your fixed investment contributions. Lower rates historically push capital out of bonds and cash and into equities. That lifts stock prices. That happened in late 2025, after the September Fed cut. I moved everything in. It worked. Here's the subplot nobody discusses. What if rates stay high and tariffs push inflation up again in 2026? Tariffs are inflationary by design. They raise prices on imported goods. The Fed cannot ignore that. If tariffs reignite inflation and the Fed holds rates, growth stocks suffer. That's the double squeeze scenario. That exact scenario is why I'm holding more cash entering 2026 than I did entering 2025. Cash in a high-yield savings account at 4 to 5% is not idle money in 2026. It's working capital. If markets correct 20% in 2026, the investor with dry powder doubles their opportunity versus the investor with none. A 20% drop in the S&P 500 from current levels means losing roughly $100,000 on every $500K invested. If you panic and sell at that dip, you lock in that $100K loss permanently. Compound math punishes that decision for 15 years. The deregulation angle in 2026, less red tape, means lower costs for U.S. businesses. That flows to earnings. Energy, banking, and manufacturing sectors typically benefit most from deregulation cycles. But remember, no single president has consistently produced sector winners. Data says diversification still wins. My core 2026 portfolio stays in a strong ETF position, same as 2025. No dramatic change needed. But I'm trimming individual stock positions that have grown too large relative to the overall portfolio. A single stock representing more than 10 to 15% of your portfolio means a 30% drop in that stock becomes a 4.5% portfolio hit. I'm also shifting a small portion away from pure growth stocks toward consumer staples for balance. Consumer staples hold up better in recessions. People still buy food, soap, and medicine no matter what. This is not a big defensive pivot. It's a small insurance adjustment. Don't confuse the two. Morgan Housel said it best, average returns over above average time puts you in the top 5% of investors. Beating the market is extremely hard. Staying in the market for a very long time is something anyone can do. Studies show 80% of actively managed funds underperform their benchmark index over 15 years. 80%. Yet investors pay those managers 1 to 2% annually for the privilege of underperforming. That's 10 to 20K per year on $1 million. A low-cost index ETF at 0.03% on the same $1 million costs just $300 per year. The difference is staggering. That's the case for index ETFs in 2026, same as every year, but there's one asset class that breaks all the rules: crypto. Let's address it directly, because in 2026, it's more relevant to your portfolio than ever before. Bitcoin approached $100,000 in late 2025. Trump's pro-crypto stance accelerated the move significantly. Solana, Ethereum, and Ripple all surged sharply in 2025. The whole space had a remarkable run. There are rumors Trump may eliminate capital gains tax on U.S.-issued crypto tokens like Cardano, HBAR, Ripple. If that becomes law, it would be one of the biggest tax advantages in investment history for crypto holders. But rumors are not law. I never position my portfolio on rumors. Evidence first, then action. My crypto allocation for 2026 stays at 5 to 7% of total portfolio, primarily Bitcoin, Ethereum, and Solana secondarily. Bitcoin's supply is fixed. Demand is growing. Long-term, I believe it slowly appreciates, not in a straight line. Historically, Bitcoin has dropped 70% from peak to trough. If you can't handle that, don't hold any. A 70% Bitcoin drop on a 6% portfolio allocation means a 4.2% total portfolio loss. Painful but survivable. Now the Bitcoin ETF exists. If you don't want to manage wallets and keys, just buy the ETF in your brokerage. Meme coins are gambling, not investing. If that's your strategy, you need to hear this clearly. Most meme coins lose 95% of their value within 12 months of launch. That's not investing, that's speculation. Stay rational, stay responsible. Only risk what you can truly afford to lose completely and permanently. Now, the most underrated asset class in 2026. Most people overlook it completely. It's cash. In an environment with rates at 4 to 5%, cash in a high-yield account earns real money with zero market risk. A $50,000 cash position at 4.5% generates $2,250 per year risk-free. That pays for your emergency fund working. But the real power of cash is optionality. When opportunity strikes, you can move immediately without selling anything. In 2025, the investor who had cash ready in September when the Fed cut deployed it at the perfect moment. The investor, who was 100% invested at that moment, had no dry powder to capitalize. Different outcomes for same event. My 2025 mistake, I had no cash. In 2026, I'm fixing that. Holding 10 to 15% dry powder is my target. To build that cash, I may sell a small portion of my larger positions before year-end 2025 to lock in gains. This is not market timing, it's risk management. Two completely different things with completely different outcomes. Market timing fails 90% of the time. Risk management protects you regardless of what the market does. Now let me give you the best insight of this entire video. This one changes how you think about your whole portfolio. Your investment horizon is the single most powerful variable in your entire financial life. More than income, more than returns. An investor with 30 years and average returns builds more wealth than a highly skilled investor with only 10 years. This means every year you stay invested matters more than the return you generate in any single year. The worst thing you can do in 2026 is withdraw from your investments because you're scared of volatility. Every year you exit costs you a compounding year you never get back. Time is the one resource you cannot buy. Now let me give you the complete 2026 actionable system, 5 layers that work together for any investor regardless of portfolio size. Layer 1. Keep contributing consistently, every single month regardless of what markets are doing in 2026. Dollar cost averaging during a volatile year like 2026 is one of the most powerful behavioral advantages you can have. Stopping contributions during a correction means you miss buying shares at 20 to 30% discount. That is the worst timing. Layer 2. Evaluate your individual stock positions. Any position above 10 to 15% of portfolio deserves a hard look. Trimming an oversized winner isn't admitting it's bad. It's protecting the gains you already earned from concentration risk. Layer 3. Maximize tax-advantaged accounts first in 2026. Roth IRA limit is $7,000. 401k limit is $23,000. If your employer matches your 401k and you're not capturing every dollar of that match, you're leaving guaranteed free money behind. The Roth IRA conversion window is open in 2026 under the TCJA extension. Use it while tax rates are still favorable. Every $10,000 you convert to Roth at today's lower rates could save you $2,000, $3,000 in future taxes on that money forever. Layer 4. Build and hold your cash buffer. Target 10 to 15% of investable assets in a high-yield savings account. This buffer serves 3 jobs: emergency fund, opportunity fund, and psychological protection against panic selling. Knowing you have cash available makes you calmer when markets drop. Calmer investors make better decisions worth thousands. The investor who panics and sells during a 15% correction loses not just the drop, but the entire recovery that follows. The parable of 2 neighbors. One sold in March, one held. By December, the holder had gained 18%. The seller was still waiting. The seller was waiting for the right time to re-enter. It never came. The market moved without him. That's always the reversal. Layer 5. Monitor tariff exposure in your portfolio. Know which of your holdings import heavily from China, Canada, Mexico. Companies with heavy import dependency and thin margins are most vulnerable to tariff headwinds in 2026. If you hold a lot of these in your individual stock portfolio, consider whether the tariff risk is fully priced in yet. Conversely, domestic-focused U.S. companies with no import exposure could benefit quietly while others get squeezed. Now here's the subplot resolution I've been building since Scene 58. The dual threat of tariffs plus sticky rates in 2026. If tariffs push consumer prices up, the Fed may resist cutting rates even if the economy slows. That's a stagflation risk. Stagflation, slow growth plus high inflation, is the scenario where both stocks and bonds underperform simultaneously. This is the rare scenario where cash, commodities, and real estate outperform paper assets. It's uncommon, but not impossible. I'm not predicting stagflation. I'm preparing for the possibility. That's the difference between a plan and a gamble. Subplot resolved? Cash buffer plus tariff awareness plus ETF core equals a 2026 portfolio that survives most scenarios. Let me now tell you exactly what I personally plan to do with my own money in 2026. No abstractions, just my real decisions. 1. I stay heavily in my core ETF position, no change. That's the engine and it doesn't need to be touched. 2. I trim any individual stock that grew beyond 12 to 15% of portfolio weight, even if I love the company fundamentals. 3 minutes. I target 10-15% cash held in my high-yield savings account, earning 4 to 5% while I wait for opportunity. 4. I keep 5 to 7% in crypto, primarily Bitcoin, and I do not add more regardless of short-term price excitement. 5 minutes, I contribute consistently every month to my Roth IRA and taxable brokerage, automated so emotion can't interfere. Automation removes the biggest enemy in investing, yourself. Especially during volatile years like 2026 could be. You think the problem in 2026 is picking the right stocks? It isn't. It's staying invested through the noise that matters. If your time horizon is 10, 20, or 30 years, the noise of 2026 is irrelevant to your final outcome. Act accordingly. You control 3 things: savings rate, account structure, and behavior. Everything else is noise you cannot control. Missing 10 of the best trading days in any decade cuts your final portfolio value nearly in half. That's the cost of sitting out. Those 10 best days almost always occur within 2 weeks of the 10 worst days. You cannot predict them. Stay invested. What's your own risk tolerance for 2026? Take the Pioneer Group questionnaire, link in description. Know yourself first. Different ages and situations need different approaches. A 25-year-old can hold 95% equities. A 62-year-old probably cannot. My goal on this channel has always been to help you think independently and make your own informed decisions. Not to tell you what to buy, not to predict the market, just to give you the real framework to make smart choices. The subplot is fully resolved. 2026 is not a year to panic and not a year to be reckless. It's a year to be disciplined. Tariffs are a real risk. Elevated valuations are a real risk. Sticky inflation is a real risk. None of them kill a diversified long-term plan. The investor who stayed the course through 2008, 2020, and every correction since is sitting on life-changing wealth today. The investor who sold in 2008, sold in 2020, and is already worried about 2026 is still waiting for the right time. There is no right time. There is only the time you use and the time you waste. That is the final truth of this video. My WAP community has full details of my complete portfolio tracking, plans, and at least 2 exclusive videos per month. It's similar to Patreon or Circle, a private community where members share ideas, track portfolios, and discuss markets. Link is below. Join if you want to go deeper than any single YouTube video can take you on your investing journey. Drop your own 2026 investing plan in the comments. I read every single one. Let's see what you're thinking. If this video helped you understand your 2026 plan better, subscribe, like, and share it with someone who needs to hear this. Most investors enter 2026 completely unprepared for what's coming. Now you're not. That's the only edge that matters.